just trying to bring people together that are interested in quantitative finance, and who better to speak to us than you, Anton. You've got an interesting career now, a interesting company, and you're doing cool things. So I'll hand it over to you, and hopefully you can demo some things for us. Thank you.
Yes, all right. Yeah, so first of all, thank you for inviting me today. I'm really excited to present for you because I spent a lot of time on these methods that I'm going to go through today. So I also encourage you after the presentation to not hold back and just shoot your questions, because yeah, it's always interesting for me to get feedback and hear from a practical perspective how these things can help people solve the problems that they have. All right. I'm quite sure that most of you have heard about Capm and mean variance. And these theories are good for building investment intuition. So basically, Capm tells you that there is a trade-off between risk and return, and mean variance teaches you that there's something called diversification. So it's probably a bad idea to put all your money into one stock for most people. But the problem with these theories is that they are poor approximation of real world markets. So here, for example, you see the historical yearly return on S&P 500. This is the blue curve. And then you have the orange curve, which is the best possible normal calibration. So you can immediately see that scenarios where you lose 40 and 20% have happened much more frequently than this nice bell-shaped curve will predict. There's also the fundamental question of what is investment risk? Because I'm quite sure that when you invest in the markets, then you are not afraid about earning too much money. I'm also quite sure that if you have a portfolio that trends upwards with some fluctuations around it, this is also something that will not keep you awake at night. But if you experience scenarios where you lose 20 or 40%, then this might hurt. So for most people, when they think about investment risk, it's the probability of experiencing large losses. But when you work with mean variance, then you are treating both positive and negative deviation from the mean as equally undesirable, which clearly goes against this principle. The important point is also that when you're doing mean variance, you are not only making this mistake for S&P 500, you are probably making it for all the assets that you are investing in. And there's also another thing that you need to remember, that mean variance only allows for linear dependencies between the assets through the covariance matrix. And not only are the dependencies linear, but they are also constant. So in a scenario where S&P 500 increases by 10% and a scenario where S&P 500 falls by 40%, mean variance will assume that it's the same linear dependency. But most investment people that I talk to, they believe that if you are in a significant risk-off scenario, then people will be buying bonds, and central banks will find a reason to cut rates so that you will get some additional diversification from government bonds, for example. But mean variance in the traditional sense is not able to handle that. So the question is then, what are the most sophisticated investors starting to do? First of all, they are not relying on simple parametric distributions. They are working with fully general Monte Carlo simulations. So you can imagine that you have this matrix called R, where along the columns, you would have your asset returns and risk factors. So this could, for example, be something like Facebook, Google, and Apple if you have a stock portfolio. In addition to that, you can assign a probability vector to each of the joint scenarios that you have along the rows. And we collect that into a prior probability vector that we call P. If you then want to implement some views or do some stress testing, then one way that you can do it is by changing these scenario probabilities into the posterior probability vector that we call Q. And here you see the basic formulation of the method that we use to change these probabilities, which is called entropy pooling and has this relative entropy objective function that we are trying to minimize. So you can also see that you have these constraints with the matrix G and A. And you can imagine that these matrices are functions of this Monte Carlo simulation. So this is how it is integrated into entropy pooling. So the important point is that these functions, they can be nonlinear. So it can, for example, be views on variances, but they need to be formulated in a way so they are linear in the posterior probabilities. And this is actually one of the main limitations of entropy pooling. But it is necessary for us to be able to run it in a fast and stable way. But if you want to have the full performance from entropy pooling, you can apply it in a sequential way. It's not something that we have the time to talk about today, but in the references, you will have an article where you can read about it. Okay, so on this slide, this is just a comparison of the old approach to the new. So instead of using the normal distribution, which we have discussed already, has many issues in relation to approximating real-world markets, you have these fully general Monte Carlo distributions and associated joint scenario probability vectors. Instead of using Black-Litterman, which relies on Capm and the normal distribution and some duct tape engineering with this parameter tau, you have this theoretically sound entropy pooling approach, which also allows you to easily implement views on variances, skewness, kurtosis, and correlation. Finally, instead of analyzing the portfolio's variance, you analyze the portfolio's CVAR. And basically, CVAR is concerned about large losses in the left tail of your return distribution. So it agrees with people's preferences for avoiding these scenarios. The nice thing about CVAR is also that it operates directly on these Monte Carlo simulations and the probability vectors. So it doesn't matter how complex your simulations are, CVAR will give you meaningful results when you use it. And actually, a side note is that if your return simulation happen to be normal and you use CVAR with the mean portfolio PNL, then actually the two methods will coincide. So you lose nothing from using CVAR in the textbook case, but you gain a lot when you analyze it for complex Monte Carlo simulation that approximates real-world market behavior. This slide is just to give you some visual examples of some of the things that you can do using the new framework. So here on the left-hand side, you see a case where we have implemented a stagflation and rate hike view. The question is, of course, how did we do it? So just to clarify, this is the view where you have low growth, high inflation, and then central banks still decide to increase rates. This is the case that most investors are usually afraid of. So it's, of course, important to know how the assets in your portfolio would behave in this scenario. The way that we implement it is by using a framework that we call causal and predictive market views and stress testing. And this is basically a combination of Bayesian networks and entropy pooling. This is a quite sophisticated method that, again, we do not have the time to go through, but in the references, you will be able to read about it and see how all of this is done. On the right-hand side, you see another example where we use entropy pooling directly, but in a sequential way. So here you can imagine that you have a 60-40 equity and bond portfolio, and you implement the view that the expected return of that portfolio is the 90% CVAR. But not only that, your correlation goes from -20 to +20. So this is a case where you are in the left tail of your portfolio's return distribution and diversification fails. So this is a tail risk scenario if there ever was one. The nice thing about using entropy pooling to analyze this scenario is that entropy pooling will give you a posterior distribution that quite clearly shows you what are the joint scenarios that you need to hedge if you want to equip this portfolio with a tail risk hedge. All right. I hope that these examples, they just give you a sense of some of the things that you can do when you use this new framework, and that it is mainly our imagination that is the limiting factor for how we use these things. So after you have performed the Monte Carlo simulations and you have implemented the views and the stress testing, you probably also would want to optimize your portfolios. And the formulation that we prefer to use is where we maximize the expected return subject to risk constraints. So here we have a constraint on the overall portfolio risk, and after that we have a constraint for deviations from risk deviations from the benchmark or some long-term portfolio. And this is usually what the clients that we talk to want to do. But when you look at this formulation, you also see that there are some other real-world nuances. So first of all, we do not optimize over portfolio weights, as in the textbook. We optimize over portfolio exposures. And basically, this is necessary to be able to handle derivatives in an elegant way. So here in the self-financing constraint, you see that we have relative market values multiplied by the exposures, and this is what needs to sum to 1 eventually. You also see that we subtract some holding costs. So let's say, for instance, that you are a multi-asset investment manager and you can get exposure to S&P 500 by buying a future or giving money to a manager that will ask you to pay a management fee. So of course you would need to subtract that management fee. This is quite straightforward. And then after that, you also would need to subtract the transaction cost that you have to pay for trading right now. An important point about the transaction cost is that they do not only decrease your return right now, but they also give you less money to invest in the markets afterwards. So you also need to account for that in this self-financing constraint. Finally, you can of course have constraints on the exposures directly. So if it's a long short portfolio and absolute leverage constraints and whatever you want. The point here is that this problem is quite straightforward to solve if you want to do it for variance. This is just second order cone programming. But if you want to do it for CVAR with fully general multi-count distributions and flexible probabilities and all of that, this is actually a quite hard problem to solve in a fast and stable way. And then in addition to that, clients usually want to introduce some uncertainty in the expected returns because optimization results are quite sensitive to that. So you don't only need to solve this problem once, you would probably need to solve it like 1,000 times, something like that, over a distribution of this expected return vector. So this is where the stability and speed becomes really crucial. Okay, so the last slide here is just some references that you can go into and read more about this framework. The first one is just an explanation of why we prefer to use variance to build intuition and then CVAR for portfolio optimization and portfolio management. It also gives you an overview of some pros and cons and gives you some nuances of this risk budgeting exercise that you saw before. Then we have the sequential entropy pooling article, which gives you a presentation of entropy pooling in its basic form and how you can get better performance by using it in a sequential way. After that, we have this portfolio management framework where you can read about why it's necessary to separate between relative market values and exposures. And finally, we have this causal and predictive market vision stress testing framework with the Bayesian nets and entropy pooling. For all of these articles, there is accompanied open source Python code that you can find documentation for on this web page. If you want to see the actual source code and some of the examples, then you can find it on GitHub. And then there is this latest edition where I make YouTube videos that goes through the open source code. So the first one just introduces the package, and then afterwards I will go very carefully through the examples that are available for this package. Finally, there's this applied quantitative investment management group that I encourage you to join, where I post about this framework and other quantitative investment management related content. And also you are welcome to connect with me on LinkedIn. But before stopping the presentation and starting a dialogue, I think it would be great just to go through a practical example and show you some of this in Python. And I hope now that you can see the code here.
Yes, all good.
Yes, all right. So here, if you navigate to examples, these are some of the ones that I will go through in the YouTube videos. And actually, for the first example, that is available online. So I think I encourage you just to go in and watch that one. Today, I will make a quick walkthrough of the fifth example, where you can see there's derivatives frameworks and entropy pooling and CVAR and variance optimization in practice. So I will just go through it quickly and focus on the results, because some Saturdays from now, you will have a video where I carefully go through all the details and talk about all the lines. I hope most of you are familiar with Python. So here we just import the packages for the first code cell, and the package that we have that is called future.tech with a short name .ft. So with this package, we have a P&L simulation, which is log normal multi-asset that could be relevant for a multi-asset investor. And here we just show some of the statistics of this simulation. So the mean, the volatility, skewness, and kurtosis. After that, we add some options P&L. And here, the important point is that with these options, we use them with notional 1. So we get these relative market values that we can use in the portfolio optimization. So finally, we just compute the P&L of these options and make a plot just to verify that it looks like an options P&L, and it does so to me. We then add the options to the initial P&L simulation and print the statistics again. So when you look at this options P&L, then it's quite clear that it's very far from being normally distributed. So a normal distribution would have skewness of 0 and a kurtosis of 3. But also just when you look at this log normal simulation, then you can also see that there are quite significant deviations from the normal distribution already. And if you had real world market data, then this deviation will be even bigger from the normal distribution. Here we just plot some of these options P&L to see that they have a very, very fat tail. And then we go into the actual portfolio optimization. So in this package, the way that you specify constraints is through matrices and vectors. So this is perhaps a bit more low level than what you have seen other places, but it allows you to specify whatever constraint that you want. So it is quite flexible in that sense. Here we just specify that the cash instruments, they should be long only, and that we can at most invest 25%, while for the options, we are allowed to have long-short exposures with a notional of at most 50% of the portfolio value. So after that, we have this mean CVAR class where we basically feed the P&L, we feed the constraints, and then this relative market values, and we say that this is this alpha value, this is for the 90% CVAR. Here you also see that if you want to do mean variance, well, you need to compute a covariance matrix, but then you feed the mean in the covariance matrix and these constraints and relative market values. So after that, we perform an optimization, both CVAR and variance, where the expected return target is 5%. And here you can just see the results of these optimizations to verify that all the constraints are satisfied. But more interestingly is to look at the P&L distributions for these portfolios. So here you see the blue curve. This is the P&L distribution of the 90% CVAR optimized portfolio, where you can see that the probability of experiencing large losses is significantly lower than when you do variance optimization. You also see that the probability of experiencing significant gains is also much higher for the CVAR portfolio. And you should remember that even though these distributions looks quite different, the expected return on both of them is 5%. So this is the optimization just with the prior simulation. Now we want to go in and implement some entropy pooling views. And here I just come up with some views where I increase the volatility of developed market equities, and I do some adjustments in the tail. So the first thing I do is just to verify that the views that I have implemented, I implemented correctly. But again, I also really like to look at the prior and posterior distribution to see the effect of the view. So in this case, you can see that I have introduced quite significant mass into the left tails of developed market equities, just to see how it will look if we perform the same optimizations as before. So when we want to optimize with non-uniform probability vectors, then the only thing we need to do is to use this mean CVAR object, but then specify that the probability vector should be equal to the posterior probability vector Q. And the same thing when we want to do mean variance optimization, then instead of computing the covariance matrix with uniform probabilities, we use the posterior probability vector. And then we can optimize these portfolios again with a 5% return target. So here first we can verify that the constraints are satisfied. And then again, we could look at the P&L distributions with 90% CVAR optimization and variance optimization, where we get the result that the probability of experiencing large losses is significantly lower for the CVAR optimized portfolios, while you still have significant upside in this case. All right, so I know that this was a very, very quick walkthrough of this example, but I just want to show you some practical examples of how you can use these things and how you can think about them, which is not just formulas. So now I'm really hoping that you have some questions and that we can have a dialogue about these things.